Hi there, welcome to The Trade. Great to have you here with us on this Thursday. Before we get set with charts, let's take a look at some of the headlines that traders are no doubt watching, with the Fed leaving rates unchanged, seeing only one cut in 2024 despite inflation coming off the boil. We are watching out for the Bank of Japan tomorrow. The Nikkei is reporting there that it is going to consider gradually cutting bond buying. Not much data out prior to the jobs data just then, but we did get New Zealand electronic retail spending falling in May, further signs of a pretty tough situation for consumers there. The IEA is reporting that oil demand is set to peak by 2029, with a major supply glut looming. And copper prices rise as that cooling U.S. inflation boosts those rate cut hopes. We'll see what it has done to the charts that my next guest has his eyes on. And Nick Twidale from ATFX on that is joining me now. Nick, hey, welcome.
Thank you very much.
Look, I know it just broke, but any initial thoughts on that Aussie jobs data?
Yeah, I'm surprised again. I think on the micro side, when I'm talking to people at the moment, I'm just hearing about sad news of people losing jobs.
Yeah.
And that's been sort of fairly consistent for the last 6 months, but every time I'm surprised that we've got another upside. So if the data's right, it's all good, and I think that does add a little bit of support to the Aussie in the short term. Once again, the Aussie against the dollar, it's going to be dominated by dollar moves over the next few sessions, and we've still got to really react, I think, to last night's moves, and I think we've got PPI tonight as well. So nice short-term spurt for the Aussie. It probably supports a view that we're going to see the Aussie appreciate on the crosses. I'd rather probably take a long Aussie position on the crosses against the euro in particular at the moment, and maybe the sterling rather than against the dollar.
Woo! Okay, so you took us to the euro, so let's take a look at a couple of the charts that you brought. Wasn't expecting that detour, but
Sorry
let's take a
about
look.
that, yeah.
I'm happy to roll with your punches.
Yeah, so this is something we were focusing on. I think most of the market was focusing on this is the hourly chart. I think the longer-term chart has similar levels. We'd got some great moves off the technical levels over the last few days. The move down from 109 we got after stronger non-farm payrolls, which was an anomaly against every other job report we got last week. And we just seem to be getting sort of a left and right from the US numbers and from the Fed at the moment. And then obviously the CPI took us down, and then the Fed sort of like gave us a little bit more strength. So we're back in the middle of the range, but I think those two levels in the euro are key now. We've come off them, that 109 level that's now trendline resistance and previous highs. And then sort of we're looking just above 107 on the downside. So to me, you trade that range, but it does feel like it's going to break one way or the other once we get some consistent data back out the US.
Well, yeah, when's that going to happen? You know, we've got that inflation read through the overnight period came in cooler than had been expected. What does that mean likely for the PPI, if anything, tonight? Well,
I mean, I think once again, you can't read too much into it because we're getting conflicting reports each day, so I think you've got to trade what you see at the moment. But to me, the longer term trades is let's actually listen to what the Fed's saying, and they've been calling on rate cuts for the last few months, but the market's just been doing what the market does and going, no, I think we're right, you know, especially US stock markets, and they're hitting all-time highs. The dollar has been, and currencies have pretty much been range bound in big ranges and fairly whippy within them. I think now, over the next sort of 2 to 3 months as we go through that Northern Hemisphere summer, we're going to look for some consistencies. But it does feel like there's more volatility on the cards because we're getting these conflicting data, like prints on an almost daily basis. And you're starting to see some of the usual correlations break down as well, which I think normally, to me, tends to predict that we will start seeing some corrections across markets.
Okay. But one currency, I mean, I know that we talked about the Aussie in relation to the jobs, bit of volatility today, clearly at 11:30, but the Aussie has not been particularly volatile.
It's been a bit boring, hasn't it? It has been stuck in ranges, and if you played that range, you'd be doing very well. And obviously over here we get asked about the Aussie all the time, and like you look all the way back, that's the hourlies, and like that range really has been, it's almost been 60, you could play 66, 67. If you had options sitting at 66 and a half, you'd be making an absolute mozza at the moment, wouldn't you? It's been a bit boring, and I think there's two reasons. I think there's been good reasons for dollar strength and good reasons for Aussie strength at the moment as well. Until we get that interest rate differential potential coming between the RBA and the Fed, then I think unfortunately we're stuck in ranges again.
Okay, what do you think is the reason? Because you said reasons it should come under pressure, reasons it should run. What are the positives, the tailwinds for the Aussie?
I mean, I think we're looking at these data prints that we're getting, and there's still sticky inflation, and we've just got this employment coming through. So until the RBA gets to feel some of the pain that everyone's talking about on the streets and cost of living crisis and things like that, they're going to keep rates relatively high. And, you know, we've still got people talking about the potential rate hikes coming through.
Yeah, I spoke with one this week, Rabobank calling for 2 rate hikes.
Well, there you go. So if you've got the Dutch going for it, and I know some of the other guys, local guys, are going for rate hikes, it makes sense from an economic point of view, because that pain's not coming through yet, it's a sad thing to say. So while we're there, we're not getting that interest rate differential, which will move currencies over the longer term. And because we're not getting that, we're unfortunately stuck in ranges. But that's not necessarily a bad thing for traders. As I said, if you trade 66, 67 for the last couple of months, you're doing very well. So you just adjust your trading strategies accordingly, I think.
Right. Well, you heard me talking about the BOJ there a little bit earlier. What could tomorrow mean for the currency?
I think we will see some yen strength out of it. And I agree with what you came up with your head. That's been bandied about the market for the last... And the Japanese are very good at this. They like to give you a little bit of forward guidance, and it comes through various sources. And you're hearing from Japanese banks at the moment that they will start to look at that bond buying situation. And I think because of that, you might see yields pop up in the yen, and then therefore a bit of yen strength coming in, which obviously supports what the Bank of Japan want to do with the yen levels. How long the market reaction lasts, I don't know. I think particularly in dollar yen, it's still the dollar side of that equation that's going to dictate what's going on. But it's good for us from a trading perspective because it gives us volatility. So.
We just want volatility.
That's all we want.
That's all we want. Okay, when it comes to the Canadian dollar, so we've got, oil being 1/4 on the Canadian dollar, commodities, same as here in Australia, but then of course dictated greatly by what's going on with US interest rates as well.
Of course, yeah, and I didn't know you were going to be hosting today, but I threw the CAD in because I know you guys always like, you always get extra volatility with CAD and oil moving around. And oil has been, when you look at my daily updates, oil, I'm getting percentages moves up and down kind of on a daily basis as well, which is great for the CAD. And obviously we had the Bank of Canada, they've come out, they're the first, right? Yep. So that's good, and that got a decent market reaction. And I think we brought this chart in, it came off nicely off that 138, but I was really bringing it out just to show the volatility we've got. And it is range bound, but they're whippy moves in that range. So there's really good opportunities in it. I think you've got to keep looking, like as everyone that trades the CAD knows, you've got to keep looking at that oil market. But once again, that dollar side of the equation will start to kick in. And with the Fed, I think this is a big call from the Fed, bigger than maybe the market reaction is, because we were looking at 3 rate cuts at the start of the year, and that was very well priced in. And you've just seen stocks move topside, and the reaction to moving down to 2 rate cuts, I don't think has been dramatic over the longer term, especially for currencies than we're pricing in at the moment. And if you look at that, the longer term interest rate differentials between the Bank of Canada and the Fed maybe, then I think there could be some more topside for dollar CAD.
Okay.
Throwing that caveat about oil as well at the same time.
Yeah, exactly. So it's a complicated but more exciting period then for currency traders.
That's what we're going for, because it's been a bit boring for the last year or so.
Knock, knock. Okay, Nick Twidale, always great to see you. Thanks so much for joining us. Really appreciate it.